If your basic salary is 1 lakh rupees, your company may be deducting 12,000 rupees every month towards Provident Fund. But here's something that surprises many employees. Legally, only 1800 rupees of your PF contribution is mandatory. The government's newly notified Employees Provident Fund Scheme 2026 has reinforced that position while introducing a few other important changes. So what does it mean for your salary and retirement savings? The new scheme retains the existing rule that 12% of PF contribution is mandatory only up to the statutory wage ceiling of 15,000 rupees a month. That means the compulsory employee contribution remains 1800 rupees with an equal mandatory contribution from the employer. If your basic salary is above 15,000 rupees, any PF contribution beyond this limit is voluntary. If your basic salary is 12,000 rupees, nothing changes. You contribute 1440 rupees, your employer contributes 1440 rupees, and both contributions are mandatory. Now consider someone with a basic salary of 1 lakh rupees. Some employers deduct 12,000 rupees from the employee and contribute another 12,000 rupees themselves. The new EPF scheme makes it clear that only 1800 rupees each from the employee and employer is legally mandatory. Any contribution on salary above 15,000 rupees is voluntary. Employees can still contribute more through the Voluntary Provident Fund or VPF, but employers are not required to match those additional voluntary contributions. This gives both employers and employees greater flexibility in structuring salaries and retirement savings. The EPFO has also simplified advanced withdrawals. Instead of 13 different categories, there are now just 3: essential needs such as illness, education and marriage, housing, special circumstances. Members can also withdraw up to 100% of their eligible PF balance, although at least 25% of total contributions must remain in the account. The new scheme also strengthens compliance. If a contractor is not independently registered with the EPFO, the principal employer will remain responsible for ensuring PF contributions are deposited. Employers will have stricter digital filing requirements, including a consolidated Form 5 containing details such as Aadhaar, PAN, UAN, gross wages, and EPF wages. Companies running exempted PF trusts will also face tighter governance, audit, and digital reporting requirements. The scheme also allows the center to temporarily reduce or defer EPF contributions for up to 3 months during pandemics, epidemics, or national disasters. Despite replacing the 1952 EPF scheme under the Code on Social Security 2020, the fundamentals remain unchanged. The contribution rate continues at 12% while the 10% rate for notified establishments also continues. The 15,000 rupee wage ceiling remains unchanged. Your UAN, EPF interest, tax treatment, nominations, balance transfers and core withdrawal rules also remain the same. The biggest takeaway is simple. The 15,000 rupee wage ceiling hasn't changed and neither has the mandatory contribution formula. What the new EPF scheme does is clearly reinforce that PF contributions above the statutory wage ceilings are voluntary, while simplifying withdrawals and modernizing compliance. Follow Business Standard for more such stories.